welcome everybody, and it's so good to see everybody in person. I've been to this show a couple of times and as a visitor, but now I happen to be behind the podium with my good friend Simon, who when we started doing this podcast, he didn't have grey hair. Now he does have grey hair from the stress of dealing with the technology every week. Because I sit in my office in home in Oxford, and he sits either in his home when it was COVID, or he sits in the office when he's working. And we've got to know each other very well. We've spent, as I say, 100 editions so far. Numbers that keep growing, several thousand a week now, of which I hope one or two of you are already listeners, and if not, I hope you will become so, because we have a lot of fun doing it, and I think you might find it helpful to listen in as well. Why did we start it? Well, I started it because I thought when the COVID pandemic hit, I didn't quite know what to do immediately with my portfolio. And I thought, because I'm an investment trust aficionado, who better than to hitch up with Simon and talk about everything that happened that week. So every week, all we do is we just talk through everything that's happened. And the great thing about investment trusts is they are listed companies, and they have to make announcements regularly. So every week, there's something like 10, 15, sometimes even 20 announcements, and we try to cover them all in an hour, which is sometimes a bit of a challenge, and sometimes not. And the key point about the podcast is we're totally independent. We don't have any ads, we don't have any sponsors, we don't have any partners, and also it's incredibly free. So you can listen to it for nothing. Can't guarantee we're like that forever, but it's been something which I've wanted to do, and Simon's very happy to do it with me, and we want to keep it going because we have a lot of fun doing it, and I think we think because of the growth in numbers, we're probably doing something right. So who are we? Why the hell should you listen to us? Well, very briefly, I've got more grey hair than Simon. I've been following investment trusts for more than 30 years, initially as a financial journalist. Now I write books. I'm the editor of this investment trust handbook, a copy of which you might be able to find downstairs, also for free downstairs. And I've also professionally qualified and done a lot of things in the city as well. And Simon has been working for Winterflood Securities for 20 years. Started as an analyst. I think he trained as an accountant, but found it too exciting. And then he went to Winterfloods. And if you don't know Winterfloods, they're one of the big three, what I would call the big three broking firms that cover investment trusts in depth. And if you own any investment trusts, and you do that through a platform, Hargreaves Lansdown or AJ Bell or Interactive Investor, any of those, the chances are, whenever you place a trade, that Winterfloods will be doing, it's better than 50% that Winterfloods will be the other side of that trade, because they handle all the deals, a lot of the deals for the big platforms, for the retail platforms. So Simon is head of research and has been there for a number of years, and what he doesn't know really isn't worth knowing. So I'm going to hand over to him. First question. We're going to do this as a kind of sort of Q&A, but we've got a few slides, but we don't want to get bogged down in them, because basically all we're good at is talking. We just talk to each other for an hour, and we're going to see how this goes. And if you've got any questions, put your hand up, but better probably to catch us later on. We will be around. Okay, Simon, so very briefly, if you're not an investor in investment trusts, well, how many people here are investors in investment trusts? Okay, fantastic. So I think we can keep this first bit quite short, Simon.
Probably jump this slide then.
We could always jump the slide. But basically, well, Simon, you give us the 1 minute version of why investment trusts are worth investing.
Yeah, my personal take is that the barriers to investment have never been so low, frankly. I mean, everybody here is clearly by definition an investor. You probably need about 100 quid in a Hargreaves Lansdown account to get cracking. But actually, to be an investor, to be a successful long-term investor is very difficult. And you can see that by the track record of any number of professional investors. So I think the advantage of the investment trust structure is it's the pool of captive capital. And what that means is it enables investment managers to invest in more illiquid asset classes or take longer term decisions or not worry about managing fund flows. So the case in point, the market's obviously been hugely volatile over the last month or so for very obvious reasons. If you're managing an open-ended fund, invariably you'll have probably been hit by outflows during that period, obviously depending on the asset class, and you have to manage that. As an investment trust manager, you can see through that. You can just hunker down and back the names that you favor. And I think that's actually a tremendous and often understated advantage. I mean, there are a number of other points that this slide's kind of picking up on, the ability to gear, the role of independent boards, I think are increasingly important. But that captive pool is hugely, hugely important. And I think probably the other key point is the greater dividend certainty that the structure provides. So not every investment trust will pay a dividend, but many do. And as you may be already aware, most investment trusts have built up revenue reserves, so they're not compelled to return all their revenue in any given year back to their shareholders. They can retain up to 15%. So many have built up this revenue reserve over a long period of time. So what does it mean? Well, you go back to 2020, for instance, where we saw many of the underlying holdings cut their dividends or suspend their dividends. Not all investment trusts, it's not a guarantee, but many, particularly those that had a dividend track record, took the view that they were going to use their revenue reserves to support their dividends. And that's frankly why we see so many what are called AIC dividend heroes. The AIC, for those of you who are unfamiliar, is the Association of Investment Companies. It's the trade body that, amongst its many roles, promotes investment trusts. But they've coined this phrase, AIC dividend heroes. And basically, they're the investment trusts that have managed to grow their dividends by 20 consecutive years or more. And I think at the top of the pile, I think we've got City of London Investment Trust, about 55 years. Names like Bankers, Alliance, and Witten, who I think are speaking later today, 47 years of consecutive dividend growth. These are quite impressive track records, and it's made possible through the structure.
Indeed, and I think the point I would emphasize here is this is very important, the governance aspect of this. Everybody's talking about governance now, but investment trusts, which they do have levels of protection that you won't get. I mean, no open-ended fund has ever gone bust. Some have tried very hard to do so, but no one's ever gone bust. But they don't have the same accountability, and they're basically, would you rather have your investment overseen by a board of independent directors in a publicly listed company, which is regulated, of course, and has to go subject to the Companies Act law, has to be compliant with the listing rules of the stock exchange, and so on. It is a very good governance structure now that boards are totally independent. Would you rather have something like that in place in your investments, or would you rather go to Link and see what happened with authorized corporate directors in Woodford? I just make that point tongue in cheek, of course. Okay, so and they're increasingly popular with people like you. I mean, basically, the private investor in investment trusts is somebody that the investment trusts want to talk to. They want you to have you on the share register. This is a big change. It used to be the city's best kept secret. Now they're actively looking for support from individuals. And I said initially, the connoisseur's choice. You've got to be relatively sophisticated as an investor, and I'm sure you are, because there are things like discounts to understand, and there's a bit of volatility. But if you are experienced, or you're trying to become experienced in investing, this is the place for you to look, because they are increasingly popular. Individuals are now about a third of the register of the average investment trust, and the average age of investment trust owners is it's not quite as old as I am, but you're getting closer. It is experienced investors, often with significant amounts of money to invest. Okay, so what's been happening to the investment trust world? We're going to briefly cover this, and then we want to get on to what is happening now, which I'm sure is what you're really interested in. So Simon, you're going to give me, please, a 1-minute take on what's been happening with investment trusts. It's a growth area, is basically the message.
Yeah, and just to explain this chart, with apologies, this hasn't been updated. So 2021 on the right-hand side was actually a record fundraising year for the investment company sector. I think it was about £14 billion, if memory serves me right. But really, in terms of fundraising, it has been a very successful period for the investment company sector. What does that mean? Is that we've actually seen a huge number of new investment companies come to the market. And really, since the global financial crisis, probably the key investment theme has been income. People looking for yield. As we all know, interest rates have been very, very low during this period, and arguably gilts and certain bonds have been uninvestable. So investment companies have come into their own, really providing exposure to what we call alternative asset classes. So they're invariably more esoteric, they're illiquid, and they can offer quite attractive forms of yield. So we've seen a number of new launches in this area. Probably the most successful area has been renewable energy infrastructure, which has done very, very well. And you may be aware of some of the names in that space. But we've seen a whole kind of range of asset classes. Shipping, ship leasing has come through. We've seen a number of specialist debt funds. And I know Jonathan's personal favorite is the music royalty funds. Invariably every week on the podcast we discuss his playlist and whether these Hypnosis or Roundhill Music have managed to tap into it yet. Indeed.
And one of my more embarrassing moments was when we were talking about one of the deals that Hypnosis had done. and they'd signed up Barry Manilow, and I just naturally assumed that he was dead, but he's not dead. So we had
He wasn't very happy.
I had to make a groveling apology the next week. I'm not sure he's listening into the podcast, but anyway, that we do sometimes have moments like that. So anyway, there's been a lot of new issuance, and also secondary issuance. But it says why. One reason why. Well, Simon's mentioned the fact that strong yields in many of these trusts and reliable yields, but also the performance has been good. I mean, one of the arguments for investing in investment trusts is they are actively managed funds, but their performance on average is superior to open-ended funds. On average, you could say, well, does that mean a lot? Not necessarily, but just describe this chart, Simon. What's been happening here?
Gosh, okay, so on the left-hand side, we've got the total return of the FTSE Investment Companies Index. So these are all the investment companies that are constituents of the FTSE All-Share. So invariably, they're the largest investment companies. There are probably about 180 or so investment companies are members of the FTSE All-Share, Scottish Mortgage Investment Trust being the largest. And what the left-hand scale is showing you the total return over that 10-year period. The data struck to the end of 2020, but we can talk about what's happened since. And then you see the relative performance, and that's against the UK market, so the FTSE All-Share on the right-hand scale. Without getting too bogged down, basically investment trust companies have outperformed quite considerably over this period. Why would that be the case? Well, it's been a good time for investors, so the gearing has obviously been positive. We've seen discounts tighten as well. And I think really the sector's been driven on by, as one of the bullets mentions here, the growth outperforming value. So a number of those kind of Baillie Gifford investment trusts have done very well. Some of the more growth areas of the marketplace as technology obviously been very strong during that 10-year period.
Yes, it's fair to make the point that the structure of the kind of, if you look through the list of investment trusts, they do or have at the moment a bit of a bias in equity terms towards global trusts. That's how investment trusts started, investing overseas for UK-based citizens back in the 19th century. And they do have had a bit of a bias towards growth recently, but that's been a good place to be, and gearing helps there. Okay, so just quickly, Simon's already basically alluded to this. These are the IPOs, initial public offerings we saw last year. And as you can see, some of them are quite specialist. They're quite interesting vehicles, some of these. Perhaps you just explain what those numbers are, the target yields and the rating there, Simon. Yeah,
so obviously not every investment company that's launched will have a target yield, but many have done. So I mentioned about the IPOs over the last 10 years, and just to put some numbers around that, since the start of 2010, we've seen over 160 new investment companies come to the market. Over 70% have targeted a yield of 4% or higher, and over 70% have been exposed to alternative asset classes. So you can see that this is the snapshot from last year. 15 investment companies launched. On average, the target yield came in at 3.6%, but you can see many of them are higher than that. The rating was when we refreshed this slide a couple of days ago. So you can see most are still trading on a premium to their NAV. One or two are struggling a little bit. But last year was a strong period for fundraising. A bit different this year.
Might just quickly explain what a premium discount is. A positive figure means that the share price is greater than the net asset value. Is that how we should simply describe it, sir?
Perfectly put.
Thank you. Okay. We're getting better at this, you see, every time. Okay, and then at the same time, not only have we had IPOs, but we also had secondary issuance, Simon.
Yeah, that's right. So a number of investment trust companies have found themselves on premium ratings. So there was a time during the 20 years or so I've covered investment companies where to find an investment trust on a premium rating was quite a rare thing indeed. But because of the performance of the sector and because we're seeing demand from retail investors, many of these investment trusts have enjoyed a re-rating over the last 10 years. They've moved to a premium rating. That means they can issue new shares without being dilutive to existing shareholders. This is the list of ongoing regular issuance to the market last year, and I'm sure you'll see some very familiar names on this list if you are involved in the investment trust sector. What this means is suddenly that investment trusts are able to grow from the investment management houses. They start to become quite attractive products to have in their stable. There was a time where if they were being entirely honest, investment houses would say, well, investment trusts, we kind of like them, but they're very difficult to grow, unlike open-ended funds. That's changed in recent years.
And I think the other message I want to emphasize here is that the great beauty of investment trusts is there's only a few hundred of them. There is a kind of Darwinian process there, unlike open-ended funds. You know, if they don't perform, they tend to disappear. The boards either close them down or they get merged or whatever. But it's what remains, you've still got a very wide choice of different strategies. And I think the key thing about those, if you look down the first 6 names, for example, it's very interesting to see that you've got Scottish Mortgage, which is a kind of long-term growth investor, and then you've got capital gearing, personal assets, and rougher, who are very defensive investment trusts. They basically, their pitch to you is going to be, we are going to preserve your capital. We're not going to lose money in any 12-month period. And by and large, they've actually succeeded in that. So it is a kind of a broad church investment trust, and it depends who you are, what you're trying to achieve. You can always find something that's going to work for you. Okay, so now, what about today? You know, here we are. I think it's fair to say this is a period we're living through, which is one that many of you may not have experienced, where we've got so many different things going on. Unfortunately, many of them negative at the moment. We've got rising interest rates being promised by the central banks. We've got the war in Ukraine, which has thrown a lot of things up in the air, obviously, a very tragic outcome. And we've also got inflation. And we're already doing this against an environment where there's a lot of debt out there, and valuations generally of equities are very high. So perhaps you could just talk through these charts about what's been happening over the last couple of years.
Sure. So obviously since the start of January 2020, you can see the impact of the pandemic on the UK market, which is the grey line on the left-hand chart, and also the investment company sector. But you can also see that investment companies really enjoyed a very strong period in 2020. So that recovery phase, led by Scottish Mortgage Investment Trust, which I think was up about 100% in that year, did very, very well. But that continued for a period of time. Different story this year, and also I should say about the discounts on the right-hand side as well. This is the sector average discounts. It's on a market cap weighted basis. So again, some of the largest funds have a disproportionate impact on that. But you can see that derating in the time of the pandemic down to 22%, came back very, very quickly, and has actually kind of tightened gently since then until we got into the start of this year. So investment trust companies have struggled this year. The index is down 10% or so, and we've seen discounts widen out. But really what's going on here, if you look at the top 15 or so largest investment trust companies, funnily enough, its names are, here we go, perfect timing. So this data was a few days ago. So actually, Scottish Mortgage was down 34%. I think this data was till about Tuesday of last week. It's actually done a little bit better since then. It had a big bounce on the back of China's news. It's now about 24%. But the general pattern is unchanged. You can see that some of the more growth-orientated investment trusts have struggled this year. Polarcap Technology, Smithson, Monks. Conversely, those names exposed to renewable energy, so Greencoat UK Wind enjoying a strong year. Trig, which is Renewables Infrastructure Group, that's in positive territory. But overall, tougher times for investment companies.
Indeed, and you will be able to access these charts, I think, after the event. There will be ways of accessing them. This is just summarizes some Winterflood research that looks at these alternative assets. I'm sorry, it's a bit hard to read from where you are, but basically it's showing the kind of yields you're getting on these infrastructure and renewable energy trusts, also some other sort of more exotic creatures, and they are typically delivering what they promise, which is high yields, but also, crucially, a lot of them have inflation linkage in there.
They do.
Okay.
Let's keep going.
Very important. Okay, so, I don't know what your personal circumstances are. I don't know how much risk you want to take. You know, what are your feeling about the world today? Obviously, it's been a very nasty start to the year. Investment trusts are best held as long-term investments, the buy and hold investments on the whole. That's the way that I've always done it. But you will find in moments of crisis, you will find there are opportunities because discounts widen, and you can, if you've had your eye on something for a long time, and you are a long-term investor, if you didn't want to buy, technology trusts when they were on a 10% premium, you might get a chance in the next, or have had a chance in the last few weeks to pick some up. But basically, you should only be doing things that you know you want to buy already and take that opportunity. But Simon, what's your experience of your clients? What are wealth managers saying? How are investors reacting to what's been going on this year?
So I think probably the key point to note that there is nobody's panicking out there. Obviously, it's been very choppy. Markets don't like uncertainty, but overall, talking to professional investors, the wealth management community, there is not a panic air out there. It's very different from March, April 2020, where it really did appear as if the world was ending at that stage. I think it's more a case of people adding to the names that they already like and also taking advantage of widening discounts.
Indeed, and unfortunately, because of the regulatory regime we have in this country, Simon is not allowed to tell you what he actually is recommending to his institutional clients or what they're doing. The regulators don't allow brokers like Simon to talk directly to you about those sort of things. But can you, just in terms of analysis, can you say which sectors are looking quite interesting from a discount point of view? Yeah,
so where we've seen discounts widen out this year, it's funnily enough, it's in the small cap areas. So UK mid and small cap, I think you're going to hear from Guy Anderson from Mercantile Investment Trust at JP Morgan later on today, and it's those kind of areas. Europe, Japan, and unsurprisingly, emerging markets, Asia Pacific. We've seen discounts widen out there. And probably the most obvious one is on the private equity growth capital side. So names such as Chrysalis and Xiaolian, though, that was on a big premium to start the year with.
And of course, if you've got a magic crystal ball and you know how this year's going to pan out, you will know exactly what to do, and you will be able to match your aspirations to the prices that are out there in the market. My experience is that there are very few people who do actually know what's going to happen any one year. The great lesson of investing in the stock market is, from my experience, is a degree of humility is always called for. If you remember last year, the things that people say at the beginning of each year, I used to track that for one of my newspaper columns. Basically, they always got it wrong. Last year, for example, all the pundits said that the dollar was going to fall. In fact, it went up, and so on. And you can go through history a lot of times. So what are you trying to do as an investor? Final word, you're trying to match what your aspirations are to the current circumstances. And if you monitor investment trusts by research, reading, or listening to the podcast even, you should be able to pick up some ideas when to go looking for the kind of things that you like. Would that be a fair summary, sir?
Spot on.
Oh, fantastic. This is my final chart for you. This is the one that's made me more money than any other in the last 40 years since I've been involved in the market. And this is the 10-year bond yield, US bond yield, the key metric, the key indicator in the world. It's been in this downward channel for, as you can see, an awfully long time. And every time it gets to the top of that channel, bond yields go down again. But will it happen? At some point it's going to turn. And I don't know what Jim Mallon's going to say later on this morning, but my feeling last year was certainly that we are potentially facing a complete regime change. We've had easy money, declining interest rates, high valuations, lots of kind of reckless behavior by investors. Watch out. If that bond yield goes through that upper line and stays there for a long period, anything above 2.3%, we could be in for some choppy times, and you want to be more defensively positioned, in my humble personal view.